overview and update of the Alliance Trust's equity portfolio. I'm joined now by two of the senior members of the investment committee, Craig Baker and Mark Davies. Gentlemen, thank you very much for joining us. Craig, first of all, remind us, what's the investment strategy that underlies the portfolio?
Yeah, so increasingly Alliance Trust has ended up being a global equity portfolio, fully invested, and it is a high conviction multi-manager approach. So from the 1st of April 2017, we've been following this innovative approach that is seen in the institutional world, and we've been running portfolios like that for some time, but is brand new really to the retail space. And so it's taking the multi-manager approach that everyone will have heard of, but really putting a twist on it. And so each of the underlying managers are running highly concentrated portfolios of just their very best ideas, so 20 stocks or less in most cases.
And Mark, how do you have any control over asset allocation if you've got 8 underlying managers buying what they want?
Yeah, so we get daily visibility on the portfolio to see everything that the managers are doing. We very much want the stock selection to be the key driver of the return. You know, we're asking these managers to pick just their best 10, 20 stocks. We want that stock selection to be the key driver of return. So we're monitoring what the actual exposures are through time to the various different regions. Where we need to, we can control the allocations to the managers so that it's not asset allocation that's driving return, it's the stock selection.
And it's probably worth just making a point there that when we originally chose the managers and how they fit together, it was such that they were bringing something very different. And actually, when you blend them together, they end up with the big macro positions, be it geography, country, sector, start to look quite similar to that of the index, so that it is the stock selection that's driving everything.
And so what kind of investor might be suited to the Alliance Trust?
Well, it's very much designed as a long-term investment vehicle. So we see this as a very good investment for the long term, where you want 100% equity exposure and a truly global approach at that. But because it has got this multi-manager approach, whilst each of the portfolios from the managers are very high conviction so that the performance expectation can be high, blending them together means that it actually has relatively low volatility similar to that of investing in the whole index, much lower than you might see from a typical single manager approach.
Well, Mark, you adopted a multi-manager approach first part of 2017. How's it done since then?
Yeah, so we went live in 1st of April 2017. We've delivered a return now of just over 10% since inception. That's outperformance of 1.6% versus the benchmark. And that 2017 very strong. 2018 was a difficult year for equities in general, but we've seen that bounce back and with a recovery through to January into 2019.
And Craig, you're not just trying to beat the global equity benchmark or a global equity benchmark, but over time you're trying to do that by 2% a year after fees. Over what period should investors judge whether you've succeeded or not?
Yeah, so the actual objective that's been set is to do that over rolling 3-year periods. But I mean, we all know that performance is very volatile from equities, and so the longer the period, the better to measure those kind of things. But the ultimate objective is rolling 3-year periods.
And isn't a multi-manager approach fairly expensive? You've got 8 underlying managers to pay, as well as everything else that's being supplied by Willis Towers Watson.
Yeah, so typically that's one of the fair criticisms of a multi-manager approach, is that it can be expensive. Certainly if you look at the average open-ended fund that runs a multi-manager approach, I think the typical TER is up in the 1.3, 1.4% per annum. What's different here is that we've been able to use our brand and scale at Willis Towers Watson. We have a few trillion under advice, $few trillion under advice, to be able to get those fees down quite markedly. And so, for example, over 2018, the OCR on the trust was just 0.65%, which actually looks pretty good relative to a number of single manager investment trusts, let alone the multi-manager approach.
And OCR stands for what?
That's the ongoing charge ratio, and so that's taking account of all of the costs of the trust.
And Mark, overall, how has the portfolio shifted over the course of the last 12 months?
So it's not been significant changes. It's a global equity trust, and as we mentioned, we want the stock selection to show through. So there's been a number of changes within the underlying stocks within the portfolio as the managers have been able to respond to volatility, particularly in the fourth quarter of 2018. But from a country perspective, it's not really adjusted very much. We're a bit underweight the US, and we have been throughout the last year or so, and we're overweight to the UK, Europe, and to emerging markets.
Why building the slight overweight position to emerging markets then?
So we see there's been a bit of turbulence in emerging markets. We see there's good growth prospects, and we see some attractive valuations there. But it's being driven by the stock selection of the underlying managers. It's very much the stock selection views away from the US towards a small number of emerging market stocks that several of the underlying investment managers see as being very attractive.
But for an investor looking at the portfolio today, how diversified are you at the sector level?
We've got a broad spread of sector exposures because we're not too dissimilar to the index. So we've got broad exposures to financials, consumer staples, consumer discretionary, industrials. We've got slight overweights to healthcare and IT at the moment. A slight underweight to financials if we were comparing to the benchmark index, but very broad exposures you'd expect for a core investment for holding over the long term.
And as you look out over 2019, what are some of the main threats and opportunities that you see out there in the markets?
So there's clearly a lot of top-down risks that exist in the markets at the moment, and whether that's from trade wars with China and the US through to Brexit, various other geopolitical risks. But that's one of the key advantages, I would say, of a core investment like the Alliance Trust, where we're very much looking to control risk. As Craig mentioned, we're trying to manage the portfolio here so it has a similar level of risk to the benchmark index, but without performance being delivered through the stock selection. So whilst we can see that there are various different threats, we feel that the portfolio for the Alliance Trust should be somewhat immunised from those risks relative to a more style-focused individual manager approach that can get more affected.
Mark, February 2019, what's the gearing level at the moment? What does it tell us about how confident you're feeling about markets?
Yeah, so we're at the just around 8% geared at the moment within the trust, and that is towards the bottom end of that range that we would operate in, and that just reflects that we are cautious of some of these top-down risks, but we also see that through the fourth quarter, a number of our managers did spot and found some good opportunities where they've repositioned their portfolios.
Moving on to how the portfolio is positioned today in the round, Craig. Can you run it through, both in terms of style and in terms of geographic spread?
So looking at the portfolio, as we've said before, we try and keep it relatively neutrally balanced against the MSCI All Country World Index. And so if you look at it relative to that, the main differences are a slight underweight to the US from a country perspective, and overweight most of the other regions, Europe and UK and emerging markets. From a style perspective, almost style neutral, so very little of a bias in there. The reality is that we've got a mix of managers, some having more of a value bias, and some of those value managers have gone quite deep value because they're really finding good opportunities at the moment. And then a number of growth managers in there who perhaps aren't quite as into the high growth companies as they might have been. So if anything, you might have a slightly defensive piece, but generally we try and keep that very style neutral overall.
And do you think your global equities benchmark has long-term got enough exposure to the growth parts of the world, Asia, the emerging markets?
So we think it's important to start as a premise with what is the overall market cap of the world. We think that's the best reflection of the opportunity set that's out there for a long-term investor. So we think that's important, but remember, each of the underlying managers has got the opportunity to look nothing like the benchmark whatsoever. And so there will be times where they'll take quite big positions, and certainly at the moment some of them are doing that. It's just they're offsetting each other to a certain extent. In terms of the growth opportunities, there's a huge amount of growth opportunities in the US market. It's important to recognise that is 50% of global market cap, and it represents close to 50% of our portfolio. But there are plenty of opportunities for the managers to go into certain parts of Europe and Asia that will be considered more in the emerging world.
And Mark, what's the exposure of the portfolio to the UK at the moment?
So we're overweight where the market cap index would be in the UK. We've got about 14% of the portfolio at the moment in the UK. And that's coming from actually about two or three of our managers that are all underweight the US, overweight UK stocks in particular.
You mentioned that you've got a little bit of an overweight in emerging markets. Where else are the major over and underweights in the portfolio?
So underweight the US and Canada and Japan. Those are the three areas. Overweight Europe, the UK, and emerging markets. Those are the key buys at the moment. As I would say though, that's very much driven by stock selection views of the underlying managers.
And not major industry overweights or underweights either. For each of the underlying managers, very different. But overall, it doesn't look wildly different from the benchmark. Again, from a top-down perspective, you'll often look at the portfolio and think it looks quite like the MSCI benchmark. When you look at it from a stock selection perspective, it looks nothing like the benchmark at all. And we always want to be saying, the reason we outperformed or underperformed in a particular period is because of the stock selection that's driven everything. Well, that's why we've chosen the managers for their skills in stock selection.
So one measure of that would be there's active money of the portfolio. So when you add up the weightings to stocks versus their weighting and compare it to the weighting in the benchmark, what proportion is active? The overall portfolio is 80% active money at the moment. So showing it from a stock perspective, the portfolio looks nothing like the index, even though from a country and sector perspective, it looks quite similar.
How optimistic are you feeling about the outlook for the next 6 to 12 months?
Well, very optimistic. I think 2018 was a tough period generally for active managers. We had slight underperformance. Most of that's come back already in 2019. And just if you have anything that leads to volatility in markets picking up and a bit more differentiation between the better companies and the poorer companies in terms of share price movement, then that's just a fantastic opportunity for active management, and in particular for managers that are running very highly concentrated portfolios, high conviction, not taking any notice of the benchmark themselves. That's really when that outperformance is expected.
Yeah, no, I'd just echo that. I think when we look at the underlying managers and their portfolios through the fourth quarter, we did see a little bit of a pickup in turnover levels, indicative of reacting to that volatility in share price depreciation, spotting opportunities in companies that maybe many of those managers have been wanting to buy for some time, and then there was the opportunity which we then expect to see being harvested through 2019 and further into the future.
We have to leave it there. Mark Davis, Craig Baker, thank you very much.
Thank you.